Hello everyone, my name is Mark Newman. Today I want to take you through the taxation implications on the sale or a trade-in of an asset that we've purchased and claimed as a tax deduction under the instant asset write-off rules. Now, what is the instant asset write-off rules? The instant asset write-off rules up to 30th of June 23 meant that we could buy pretty well any asset and claim as a tax deduction in the year of purchase. So for example, a vehicle, let's say we purchased a vehicle for $50,000. We could claim that in the tax deduction of year of purchase. So what does that actually mean though? Because we've claimed it as a tax deduction in the past, it now has a taxation value of zero. That is, we've claimed a $50,000 tax deduction. If we're a company and our taxation rate was 25%, we would have had a taxation benefit sometime in the past of $12,750. As of 1 July 2023, the instant asset write-off rules have been reduced such that we can only claim the instant asset write-off for assets under $20,000 and assuming our turnover is also less than $10 million. So what happens when this asset is now sold? So let's say we want to trade in the vehicle. If we do a trade-in, there's two transactions we need to consider separately. One is a sale and the next one is the purchase of the vehicle. So let's say we go in, we get offered $30,000 for the vehicle. What that means is because the asset for tax purposes has zero value, the $30,000 will be profit. Assuming you're a company at 25%, that's going to result in a taxation bill of $7,500 that we'll have to pay when we lodge our next taxation return. Now, if we buy another $50,000 vehicle, what's the taxation implications of that? So the new vehicle costs $50,000, which is obviously over the $20,000 limit. So therefore, we have to depreciate it under the small business pool. If we put it into the small business pool, we get to claim a 15% tax deduction in the first year. So 15% of $50,000 is $7,500, which is a tax deduction. So again, at the company taxation rates, that would save us $1,875 in tax, which would leave us overall with a taxation bill of $5,625. Also, if we're looking at what our income will be for the year, we'll have $30,000 profit, $7,500 as a tax deduction. We'll therefore have an increase of profit of $22,500 as well for the year. Now, what happens in subsequent years? Do we still get to claim the vehicle as a tax deduction? Yes, we do. So in the pool, the next year we'll get to claim 30% of the reduced value. The reduced value is $50,000 less 7.5 times 30% will give us a tax deduction of $1,275. Now that amount will continue on for a number of years until it gets down to $20,000 and then we can write off the final balance. So just be aware, if we're looking at trading or selling equipment or vehicles that we've claimed previously as a tax deduction under this asset write-off, there's going to be taxation implications that we just need to be aware of. If you have any questions, please do not hesitate to reach out. Thanks for listening, Mark Newman.